Part 1. The Subversive Hook. What looked like the right path. There was a version of financial life that almost everyone recognized. It had a shape, a timeline, a sequence that felt logical and safe. Go to school, get a degree, land a stable job, open a savings account, pay your bills on time, build slowly, retire comfortably. It was the map that entire generations followed without question. And for a long time, it looked like it worked. People watched their parents walk that path. They watched neighbors buy homes through that path. They watched society reward people who stayed inside the lines of that path. So they followed it. They did everything the system asked of them. They worked harder. They stayed loyal to employers. They saved what little was left after expenses. They avoided big risks. They trusted the process. But something quietly started to break. The savings accounts stopped keeping up with the cost of living. The salaries stopped growing at the pace the bills did. The promotions that were promised took longer to arrive or never arrived at all. The house that was supposed to be affordable became something that required decades of sacrifice. And somewhere in the middle of doing everything right, people started falling behind. Not because they were reckless, not because they spent foolishly, not because they lacked discipline, but because the system they trusted had changed around them, slowly, quietly, and no one had told them. That was the first crack. And into that crack, two of the most powerful financial forces in modern life quietly entered. The first was debt, repackaged, relabeled, and sold as opportunity. The second was a savings culture that told people to be responsible while making responsibility nearly impossible to sustain. And together, they created the perfect condition for the third force to thrive: the get-rich-quick trap. Part 2. The Hidden System. Something was always off, but no one said it. The system was not new. It had been operating quietly for decades, long before most people noticed the cracks. And because it operated quietly, because it dressed itself in the language of opportunity and responsibility and growth, it avoided serious questioning for a very long time. Debt, for example, was never introduced as a danger. It was introduced as access. When credit cards arrived in mass circulation in the 1960s and 70s, they were framed as a tool of convenience, a way for ordinary people to smooth out the rough patches of life, to handle emergencies, to participate in an economy that required spending. Nobody talked about the compound interest. Nobody explained how minimum payments were engineered. Nobody made it clear that the business model of lending was not built on helping people get ahead, it was built on keeping people paying. The language was always soft, the messaging was always warm. You deserve it now. No interest for 12 months. Take control of your finances. Control, that word appeared constantly, but the control was never truly in the hands of the borrower. And savings culture operated with a similar illusion. The idea that responsible people saved money, that discipline and frugality were the markers of good financial character, was not wrong on the surface. Saving was important. Everyone understood that. But what the culture rarely acknowledged was the environment savings existed in. In a world where wages had stagnated relative to inflation, where housing costs had outpaced income growth for decades, where healthcare and education had become enormous financial burdens, the advice to just save more started to feel less like wisdom and more like a quiet accusation. People who couldn't save weren't lazy, they were squeezed. But the system never said that. The system said they weren't trying hard enough, that they needed more discipline, more sacrifice, more patience. And most people, because they trusted the system, accepted that framing. They blamed themselves. That self-blame was important because it kept the attention on the individual and away from the design. Part 3. The Origin Story. How the system slowly built itself. To understand why the trap became so effective, it helped to understand where it came from. After World War II, Western economies, especially in the United States, experienced something unusual: a period of genuine broad prosperity. Wages rose, manufacturing expanded. A single income could support a family. Homeownership was within reach of the working class. That era created a cultural memory. It planted the idea that hard work reliably produced upward mobility, that the system was fair, that following the rules led to reward. And then the conditions that made that era possible slowly changed. Globalization moved manufacturing. Technology began replacing certain categories of labor. The gap between productivity and wages, which had tracked together closely for decades, began to separate. Workers became more productive. Their wages stopped reflecting that. But the cultural belief remained. The story of hard work and reward persisted long after the economics behind it had shifted. Banks understood this gap. In the 1970s and 80s, as real wages began to stagnate, financial institutions began expanding credit access. What people could no longer earn, they could now borrow. The consumer economy kept growing, not because incomes were rising, but because debt was filling the space income had left. This was not a conspiracy, it was a market response. But the result was structural. Millions of people began substituting credit for income. They began living at a standard that technically required borrowing. And the financial system, which earned money on that borrowing, had every incentive to keep credit flowing, keep limits rising, and keep the monthly payment structure feeling manageable. The savings culture, meanwhile, emerged partly as a counter-movement. Personal finance writers and advisors in the 1980s and 90s built careers on the message of discipline and savings. Books like The Millionaire Next Door celebrated frugality. Financial educators warned about debt. And their advice wasn't wrong in principle, but it was being given inside a system where the math was increasingly difficult. Telling someone to save 20% of their income when 60% of it went to housing, food, transportation, and healthcare left very little room for discipline to work. The advice was real. The environment made it nearly impossible for most people. So the gap between what people were told to do and what they were actually able to do kept widening. And in that gap, something else grew. Part 4. The wealth traps. It looked like a benefit, but worked like a trap. Trap 1. The debt cycle dressed as opportunity. When credit was sold to struggling families, it arrived with the language of empowerment. A credit card was not described as debt, it was described as a financial tool, a safety net, a way to build a credit score, that invisible number that determined access to housing, to cars, to sometimes even employment. And people needed credit scores. So they used credit, responsibly at first, carefully, making payments, staying within limits. But the system had a design built into it that most people never fully understood. Minimum payments. Credit card companies were not legally required to demand full repayment each month. They were allowed and financially incentivized to let customers pay a small fraction of their balance and carry the rest forward with interest. This created what financial researchers later called a revolving debt trap. A person with a $3,000 balance who paid only the minimum each month could spend years paying off that debt while paying far more than the original amount in interest. And because the debt never disappeared quickly, it stayed, it accumulated, it compounded. And because carrying a balance was normalized, because almost everyone around them seemed to be doing it, people accepted it as a standard feature of adult financial life. It wasn't. It was a feature of a lending model designed to maximize interest revenue. But it felt normal, and normal things didn't get questioned. Trap 2. The savings myth that punished the disciplined. There was a generation that believed in savings accounts deeply. They were told that keeping money in a bank, safe, liquid, accessible, was the responsible thing to do. And for a long time, that advice had real logic behind it. Savings account interest rates in the 1970s and early 80s sometimes reached into the high single digits or even double digits. Keeping money in a bank actually grew that money modestly. Then interest rates fell. By the 2010s, the average savings account in most countries offered interest rates so low they didn't keep pace with inflation. Money sitting in a savings account was, in real terms, slowly losing value. The purchasing power of those savings eroded year by year. But the cultural advice didn't change. People were still told to save, still praised for having savings, still encouraged to put money in accounts that were quietly falling behind. And the people who followed this advice most faithfully, the most disciplined, the most patient, the most rule-following, found themselves in a strange position. They had done everything right, and yet their financial position wasn't dramatically improving. The trap was invisible because it operated through math, not through drama. There was no single moment of loss, just a slow, quiet falling behind that only became visible over years. Trap 3. Lifestyle inflation and the moving finish line. As incomes grew, even modestly, the culture of spending grew faster. This had a name in behavioral economics: lifestyle inflation, or lifestyle creep. It described the way spending expanded to meet and then slightly exceed every income increase. A raise at work didn't produce savings, it produced a slightly better car, a slightly nicer apartment, slightly more expensive habits. Social circles shifted upward with income. The reference point for normal spending kept moving. And this wasn't entirely personal weakness. It was driven by an advertising economy that had spent decades learning how to connect spending with identity, status, belonging, and emotional reward. Buying things felt good. It felt like progress. It felt like proof that the hard work was paying off. So people bought. And the system that sold them things was deeply skilled at making each purchase feel reasonable, justified, and deserved. The result was that income growth rarely translated directly into wealth growth. The money moved, it circulated, it went to companies, to lenders, to landlords, to service providers. But it didn't accumulate in the hands of the earner the way it theoretically should have. Part 5. The behavioral shift. Humans adapted to the system, even when it hurt them. What made all of this particularly powerful was not just the structural design, it was how people responded to it psychologically. Humans were remarkably good at adapting, at normalizing, at finding ways to make sense of difficult circumstances. When the savings path stopped working, people didn't immediately abandon it. They told themselves they needed to try harder, save more, cut more, wait longer. When debts started accumulating, people didn't panic. They managed it. They restructured it. They told themselves everyone had debt. They looked at their monthly payments, found them survivable, and continued. When income growth stopped outpacing expenses, people made quiet adjustments. They worked more hours. They took on side work. They deferred bigger dreams, home ownership, retirement security, financial independence, to a later date that kept moving further away. And through all of this, the most psychologically significant thing happened. Desperation started building. Not loud, explosive desperation, quiet desperation. The kind that accumulated in the back of the mind while daily life continued on the surface. The kind that made people more open to promises. And this was where the get-rich-quick trap became truly powerful, because the trap didn't prey on greedy people, it preyed on exhausted ones. It preyed on the person who had followed every rule, worked every hour, saved every dollar they could, and still found themselves behind. It preyed on the person who was not asking for luxury, just for a way out of the quiet, grinding anxiety that proper financial behavior was supposed to have eliminated by now. The get-rich-quick promise arrived at exactly the right moment of vulnerability. It was the online course promising 5 figures a month with minimal effort, the investment opportunity promising returns that outpaced anything a savings account or index fund could deliver, the business model that claimed to offer financial freedom within months rather than decades. These promises were not always outright lies. Sometimes they contained real elements of possibility. Sometimes the person selling them had genuinely succeeded. Sometimes the method described had worked for someone. But the success stories were rare, and the conditions that produced them were rarely replicable. The math that made the promise sound achievable was usually built on extreme best-case assumptions. None of that mattered to the person who had been grinding for years without breakthrough. Because when the legitimate path had failed, or felt like it was failing, the illegitimate path started to look rational. That was the psychology. Desperation didn't make people foolish. It made a certain kind of risk feel reasonable. It made the cost of trying, money, time, hope, feel worth paying compared to the cost of continuing with a system that wasn't delivering. And the people who built and sold these opportunities understood this psychology precisely. They did not target the financially comfortable. They targeted the financially exhausted. Their marketing was not about luxury. It was about escape. Stop trading time for money. Work once, earn forever. Your boss doesn't want you to see this. The language was always about breaking free from a system that had failed the viewer. And because the system had genuinely failed many of the people watching, the message landed. They believed it. Not because they were naive, because they were desperate. And desperation had a way of recalibrating what felt possible and what felt worth risking. Part 6. The philosophical close. The system still runs. Most still don't see it. There was a moment, repeated quietly across millions of individual lives, where someone sat down and looked honestly at their financial situation. They saw the debt that hadn't moved much despite years of minimum payments. They saw the savings account that had grown slowly, far more slowly than the cost of the life they were trying to afford. They saw the income that had risen over the years, but somehow never created the breathing room they had expected it to create. And they felt something. Not anger, not panic, something quieter and more unsettling. A recognition that the story they had been told, the one about hard work and discipline and patience and reward, had not been entirely honest. Not dishonest in an obvious way, not dishonest through outright lies. Dishonest through omission, through framing, through a cultural script that described the ideal path without describing the structural obstacles built into it. Nobody had explained that the savings account would lose ground to inflation in a low-interest environment. Nobody had laid out how minimum payment structures on credit cards were engineered to produce long-term debt. Nobody had acknowledged that wages and productivity had quietly disconnected, making the old promise of work equals reward increasingly unreliable. Instead, people had been handed rules, and the rules had been presented as sufficient. Follow them, and the outcome would come. But the outcome required more than rules. It required an environment where the rules actually worked. And that environment had quietly shifted without announcement. The debt industry still ran. It had grown more sophisticated, more data-driven, more precisely targeted at the people most likely to carry balances. The savings culture still existed. People were still told to be responsible, still praised for frugality, still gently blamed when their savings didn't add up without acknowledgement of the structural pressure making savings difficult. And the get-rich-quick industry still thrived. It had evolved into digital courses, crypto promises, social media wealth displays, and algorithmic marketing that found the financially exhausted wherever they scrolled. The three forces worked together without coordination. They didn't need coordination. They simply occupied the same space, the space between what financial life was supposed to look like and what it actually felt like for most people. Debt filled the gap between income and expenses. Savings culture kept the blame pointed inward, and the get-rich-quick promise waited quietly for the moment when the person had tried hard enough, long enough, that the impossible started to look worth attempting. Most people would move through these forces without ever naming them, without ever stepping back far enough to see the full architecture, without ever understanding why, despite their best efforts, the financial ground kept shifting beneath them. Because the system wasn't designed to be seen. It was designed to be lived in, accepted, adapted to, passed down to the next generation as simply the way things worked. And perhaps the most important realization wasn't even about debt or savings or the false promises of quick wealth. It was about attention. The system had always been most powerful when people were too busy surviving it to examine it. Every hour spent working extra to cover debt was an hour not spent understanding the debt structure. Every moment of shame about insufficient savings was a moment of attention stolen from the economic conditions producing insufficient savings. Every desperate search for a faster path was a search conducted in exhaustion, exactly the mental state that made critical thinking hardest. The trap was not just financial. It was attentional. It worked by keeping people focused on the wrong level: personal behavior, individual discipline, private struggle, while the structural layer operated largely undisturbed. And that realization, the slow, quiet recognition that the struggle had never been only personal, was perhaps the most unsettling and valuable thing a person could carry forward, because it changed the questions being asked. It moved the question from, "What am I doing wrong?" to something harder, quieter, and far more important. What was I never told about how this works? And that realization changed everything. For every person who sat with that question honestly, who looked at the debt, the stalled savings, the exhausted hope, and chose to understand it rather than just endure it, something shifted. Not overnight, not dramatically, but in the quiet way that real understanding always works. That shift was where it began.